So I think we're good to start. So tēnā koutou katoa. Welcome to, I think this is our first CEF Group webinar of the year. We've got a few more lined up in the coming months, and also this year again CEF Group will be hosting the Assembly of Investment Chairs with NZ Super and ACC, and we will also be holding our symposium, and between now and then holding plenty of webinars. So today it's a real great pleasure to welcome Ben McNeil, and he's going to talk to us about understanding transition risk beyond carbon intensity. Ben is a founder of McNeil, which is an Australian company that is looking to transform how financial markets look at transition risk. And it's really been a pleasure to be working actually with Ben along with Quinn Wynn on applying machine learning models to predict carbon footprints. So yeah, Ben has a really impressive background. He did a PhD from the University of Tasmania and CSIRO. He's a climate scientist, so oceanography. He did a fellowship at Princeton and is also associated with the University of New South Wales. So really incredible pedigree. As I said, we've been working with Ben and his team for a year now, and it's really been a really fruitful collaboration. So welcome, Ben. You have 36 guests from a range of backgrounds, some of our masters in finance students doing my climate finance paper, but I see academics on the list. I see people from the Reserve Bank and people from industry, from the investment industry. So you have a really interesting and mixed audience. So what we'll do is we'll let you talk till about I don't know, 40 or so minutes. I suspect you're going to get questions. People in the audience, feel free to put questions into the chat, and then we'll try and answer as many of your questions as we go along. So very much welcome to the session, and I let you share your screen now. Thanks, Ben.
Okay. All righty. Can everyone see that? I hope so.
Yeah, we can see that, Ben. Thank you.
Great. So it's really great to be here, Ivan. And just to echo the sentiment, it's been fantastic to work with your team on a lot of the challenges that we're facing on carbon and transition risk. So it's been really great. And today I really wanted to just give quite a overview. So it was really great for me to do this, and thanks for inviting. And you know, it's timely given I think this week the working group 2 of the IPCC was just released, and I'm sure a lot of people have seen the headlines on that. And really I'm not going to talk about the science, and I'll get into a little bit of my background, but really it's all around how do we deal with this huge challenge we face, and finance is a huge area of impact and reach. So today I'm really going to talk all about carbon finance and transition risk. So yeah, so we'll go from there. Hang on, it's not really working very well. So in terms of just to give you some background on me, sorry. So my background is actually in as Ivan said, is in science. So I had 20 years as an academic, and really carbon has been my career. In particular, my expertise is in understanding the flows of carbon in the natural world. So this is a plot, contour plot from my team. I had some postdocs and students quite a number of years ago now, but this is a plot of the actual carbon fluxes or carbon flows in the ocean. And this is some of the work that we used to do, is try to have these massive data sets in the ocean and understand where carbon's going. But, you know, and so that was my career as an academic, understanding carbon cycling in the ocean and how climate will impact that. Then I transferred to finance. And so that's a very different space than the natural world, because we have, you know, the data set is very, very different. And I came into finance, the climate finance space, a few years ago, and now I'm fully into this space now, and I'm only somewhat doing research on the side, like we're doing with Ivan. And I have to admit that, you know, I'm not a financial guru. The financial guru is my co-founder Michael Lebman, who's in this shot here, and we founded Emmy a few years back, and he is I guess you'd call him he's the financial wonk academic in our team. So I've been learning a lot from him. So a lot of this is what I'm talking about today, beyond the climate science itself, is really hands down from Michael. So he'd also be another, there'd be another great seminar to have if Michael was on, Ivan, just to let you know from that perspective. But really, carbon finance now is now my world. So shifting from the natural world into the, I guess you'd call it the social systems. So today I really wanted to take on a few different things. So in terms of understanding this carbon transition, what is it? What's the challenge we face here? Two, I'm going to deep dive on actually the components we need to get to a better understanding. So the first bit is the carbon data problem, and that's really my element here in terms of the working relationship I have with both the Otago team and at Emmy. Then we have applying that. So how do we apply the carbon data to then understand the financial risk from metrics? And there's a number of different metrics I'll talk about. And then understanding then how does the future look here? Taking those metrics, and then how do we apply scenarios based on future climate warming, and then how do they apply to finance? And then I'll sort of wrap it up with some sort of key insights. But that gives you a sort of general overview of where we're going to head today in the talk. First things first, what's climate risk? Well, yeah, as I said, you've seen probably the news around, you know, what's happening with the IPCC. The climate change is happening. It's CO2 is a multi-generational greenhouse gas, in the sense that it stays in the atmosphere for thousands of years, so hundreds to a thousand of years. What does that mean? So there's to think about what that is doing to the planet. You've got two elements here: the physical risk of that, so, you know, sea level rise, extreme events, you know, things you've heard of, heat waves, those types of things. That's the physical manifestation of climate change, right? So that's on the right-hand side here. You've got that finance, and then when you translate that to financial risk, well, that's infrastructure damage from oil rigs in the ocean, or, you know, heat waves or droughts, agriculture risks. There's obviously quite a big impact from the physical side of things, damages to assets. So there's a cost risk and a revenue risk based on the physical damage. The carbon transition risk is not the physical manifestation of climate, it's the response. It's our response to that. So if you think of net zero targets, and we'll get there in a couple of slides, really it's all those types of, how does the transition to that low carbon economy or the net zero world then impact the financial or business or market. So there's reputational risk, so consumers can shift to low carbon. That's a cost and revenue risk for a company. And you've got market shifts in the supply and demand. You see that now that's happening. There's a lot of shifts in certain areas towards low carbon products. Also costs and revenue. Regulatory, you've got bodies, the US SEC last month, really a really big one that landed. They're now regulating around at least disclosures. So that's coming board in terms of, and then their taxes or carbon prices or what have you from the regulatory. And then you've got legal. Legal is sort of, that's where that comes into the tranche of sort of where you've got activist investors coming on, taking on companies who aren't doing anything. So the carbon transition risk covers quite a few different areas in terms of the overall tranche. So we are focused purely on this area in terms of this talk and also at ME. And there is a reason for that. The reason's pretty simple. I come from the physical world, but it's really how we act over the next 10 years is going to cause huge change. It's everything to A, solving the problem, but B, in terms of the impact on finance and business, it's that change, this carbon transition is going to be hugely more impactful than physical climate change, because physical will take decades to wrap in, and there is a physical risk there. But the transition, that is what we do, and is far greater. So we need to really try and solve that today to really empower the world to get to that net zero world in the future. And this is, I don't know if you can see this, but this is the coronavirus, so COVID. You can see, and this is a shot of a town, I think in the UK, just during lockdown. So even though the physical impact of COVID was happening and the impact was happening, obviously the response was massive. So this gives you the response. So the carbon transition risk is that response, if you think of it from that perspective. And you can see once the manifestations from the physical world start to come into the ether within our social systems and how we operate in societies, you can see the transition could happen quite quickly. Not on, I guess, on the scale of a pandemic, but still quite quickly. So that's why we're focusing on carbon transition risk. Okay, so if you think of carbon transition, what is this transition we're going to be imposing? So it really depends on how you think of the world, but in terms of the science, here's a plot showing you the net CO2 emissions, about 36 billion tons on the left there each year from the industrial world of this is carbon dioxide. And you can see over the coming decades, to give a pathway towards limiting, a 1.5 degree warming, then we really have to rapidly decarbonize. And you can see, yes, this is what the science, I think you've seen this probably before, many of you, the science is saying, yes, we need to go down this pathway to limit these physical risks. The good news is that a lot of most countries are actually pledging at least towards this net zero. So net zero being, about here, net zero by 2050 in terms of their pledges. But to do that, you can see over the coming decade, a huge drop sort of would have to occur. And even if that doesn't happen, the take-home message here is that the carbon constraint is coming. Depending on the scale and where we get to, it's coming, and it's already sort of here in the sense that people are shifting in terms of markets towards low carbon. So really the take home here is, let's hope we get here, but even if we don't, there's a huge change and readjustment to business happening and markets because of this carbon transition. So what's happening in the real markets? And this is where I've come from being quite skeptical of movements. I've been in this space for 20 years and seen how politics moves so slowly. But now, if you look at financial markets, really there's some big players now really embracing this. This is a monumental change happening in the way markets are priced and operate. And so Larry Fink, who's chairman CEO of BlackRock, who I think they manage 10 trillion or something, some massive number, the largest money manager in the world, really has, I think 2020 in his letter to shareholders, talks about how there's a fundamental reshaping of finance happening. So this carbon shift, this climate shift will mean that every company and industry will be transformed over the coming decades. So we really need to have structures in place to actually empower that. And that's where we, my mission is over the next coming years to really help that happen. So if you look at another interesting thing, if you look at that trend of what Larry was saying, Larry Fink, the Global Sustainable Investment Review published this really deep review in 2020 of where in finance, and I guess you'd call this sustainable finance. Sustainable finance is quite broad. It's not just carbon, but let's just, for the purpose of this, focus on the carbon side of things, and we can tranche this. It shows the trends. So this is showing the trends in each category of sustainable investing from 2016 through to 2020. So green, older, sort of dark blue is newer. And so there was actually, I don't know if you can see this, but the one I want to show you here, this negative exclusionary screening. So what traditionally in finance a lot would do, they'd take a vendor, an ESG vendor, and they would get some data of companies, and then they'd exclude certain companies, like, for example, fossil fuels. Like, that's basic in terms of if a company has X amount of coal that's in their bottom line or their products, then they exclude them from investment, as an example. That's what exclusionary screening. You can see there was actually, there's quite a lot still going up until 2020. There's quite a lot still going in terms of that that screening. But what you can actually see also is this integration. So this last part here, this is where it started at green and now it's really taking off, in the sense that screening can only do so, and I'll get to this later, but screening is just a very hard sort of simplistic way of dealing with these issues. And this integration is where the next tranche of big opportunity lies, in that carbon is not a binary. Carbon's not a binary problem. It's a transition. So there isn't a answer here and a solution here. There's infinite possibilities. So you have to integrate, in this case, carbon within finance to then allow markets to really shape the future in the most efficient way. And so this is the really basis of what we're trying to do also at ME, is really moving towards that integration. How do we integrate this huge carbon, this external cost of carbon and climate to finance? And that's where we're really passionate to be leading. So what's the goal here? So how do we do this? So really what we need in finance is the capability to provide a forward-looking but carbon-adjusted valuations. That's it. It's carbon-adjusted valuations for companies and portfolios, and that's what we've been working on the last few years at ME. And so I'll take you through some of the challenge of doing that and how do we do that. Okay, so how do we actually do this? How do we do something like that? So the first thing, you need data. So here's a company. Let's say we have a company. We have financial data that's very well reported. It comes in every quarter. We know what it is, from revenue to EBITDA to debt to all sorts of other fundamentals. There's carbon data. I'll get to this in a little bit. Carbon data has scope 1, scope 2, scope 3 from the company. But then you have this other area which is imposing, I guess, your will on the finances of a company, which is the climate area. So there's different scenarios that are playing out in the future. There's different carbon budgets that may play out, and there's different carbon prices. So they're the three different data sets and externalities that are coming into this space from the data side. From the data, then you can build metrics. So what are the metrics? We have traditional metrics like carbon footprint. and carbon intensity, weighted average carbon intensity and EVIC, all these other intensity measures that sort of combine elements of this carbon and the financial data. And then we have new measures, which I'll talk on a little bit later, which looks at the entire ecosystem here and gives a holistic view of a company's carbon efficiency. So what these do, these metrics down the bottom, is that they're essentially trying to integrate the finance with the carbon and at least in our case the climate data to allow markets to better understand where the risks lie from a financial perspective. And that means that they can make better decisions. That's the theory behind what we hope will happen. So really, this is the area that I'm going to talk about today, is this area here, and some of the metrics, really sort of understand those two, because that's where the biggest uncertainties lie. This obviously isn't. Climate data is pretty certain too. There's obviously a future and how there's differences of how things will play out, but in terms of the science, it's pretty solid. So I'm going to talk more about these two areas. So let's talk about the carbon data. So if we look at company carbon emissions, there's a huge problem. There's 4 sort of tranches, and this is where I came in from the natural world thinking, wow, this is very different. But really there's 4 different problems that we have to try and fix. The first one's really there's not coverage. To give you a perspective, most of the reported data out there covers, I think the CDP, which is the Carbon Disclosure Project, they this year in February disclosed about 7,000 companies. Of course, the market's 10 times greater than that in terms of companies. So there is really a lack of coverage from the reporting data. Also, when it is reported, it's often very old. So sometimes 18 months, 2 years old. There's a lag there. So to try and actually help the markets towards net zero, empower them, we really need newer data. We need quarterly data, to really give the information ecosystem what they need. The third thing is scope 3, which I will talk about. There's a really big issue on scope 3. It's hard. The final one, just quickly, when we think about reporting, you've got voluntary reporting from companies. We don't know the trust and uncertainty of those. So various companies do a great job of really deep diving on their emissions. Others don't. And as I said, 80% of the market just doesn't report at all. And even though there's actually some good legislation coming through from the US and the UK and probably and in New Zealand actually as well, and elsewhere, even with that type of legislation, you are still going to get these problems. So it's not going to be fixed by legislation per se. So we have to solve that. So really, I'll get to how we've tried to. I do want to focus a bit on what is these different types of emissions. A lot of you may not know the different types of emissions for a company. So for any company, they can report scope 1, scope 2, and scope 3. Scope 1 is the sort of the direct emissions from the company facilities, from their vehicles, from their processes. That's quite well captured, and particularly within the reporting anyway. Scope 2, that's indirect from something like purchased electricity or cooling. But really, scope 3 is where the difficulty lies. So these are the downstream and upstream activities of your business. So it could be anything from use of sold products to investment to employee travel. To give you an example, use of sold products is probably the biggest one in energy. That's where, for example, an oil company, they have a certain element of scope 1 and scope 2, but of course, it's only when we drive our cars that's when the carbon gets emitted. So that's use of sold products. So to quantify these levels, and scope 3 is quite hard. I know many companies, I know like BHP and Rio and sort of bigger companies do these very well, but they have to invest a lot in terms of trying to understand that. So scope 3 is always going to be difficult to report. So the question is, what do we do about all those things, those problems in the data world? And this is where our work with Otago has been really great. And I'll take you through how we approach this issue. So the first thing is we need to aggregate all the reported data. So we take the reports from many different sources, CDP, other providers. But the next bit that really is important is building better models to predict emissions. So what does that mean? So, well, when they're not reported. So we have invested a lot of time into understanding if a company reports financials every quarter, the idea is that we can build models that actually predict emissions to an uncertainty, to a given degree. And so predict emissions for these companies based on just financials. So that allows us to really expand the scope, both in terms of the magnitude or the coverage of emissions. So any company that reports financials, we can essentially theoretically cover, but also companies to fix the old data problem, companies, big companies that are going to report that may not have over a year or so, we can also provide guidance on where their emissions are based on the latest quarter. So you give more timely emissions data as well from that perspective. The most important thing I want to mention here is the uncertainty bit. I'll get to that into the end. And that's one of the big problems with the traditional approach to data is this single point in time. I'm a scientist. Anything single point in time just I have nightmares. We need an uncertainty, and that allows us to propagate through these uncertainties. And I'll get to that a little bit later. So once we build these better models and expand the scope, we can then compare the reported to those predictions. And then that allows us to via a lot of data science techniques to do a number of different outlier analyses and trust checks to really understand how trustworthy each of these company emissions are. Finally, what's the outcome? Well, the outcome will be quarterly data for any company that's reported financial data with uncertainties. So we get to the carbon, we can actually solve or manage the carbon data problem that way via this process. So what we have today, although this is evolving, and I know Quen, who's one of Ivan's postdocs is on the line here, I'm sure she's done some amazing work in this machine learning area that we've worked with her in terms of predicting carbon emissions from finances. From that, so just to give you an overview, generally there's about 6,000 companies that report. That's sort of a CDP. That's not scope 3, by the way, but I'm just taking it up to 6,000. We expand that by building our models. We can expand that to about 36. So we have a coverage of pretty much that covers most of the global market based on this process. So that's how we've managed the data problem. Once you do have data, let's say, so we have those data from 42,000 companies, what's the next step? Because obviously just emissions themselves don't do much. It can tell you about broad targets from a total perspective, but it really can't be compared to other companies, a big company versus small company. There's no standardization and that means you can't quantify carbon financial risk. So there's these evolution of carbon metrics that have come online over the last, I guess it's still new, but it's come online that helps you towards quantifying risk. There's obviously just the carbon footprint, as I said, and that's finance emissions. So the emissions relevant to your investment. That's just, as I said, doesn't tell you a lot. Tells you something in terms of future targets, maybe in terms of where you're going and how the impact on how those targets will impact the overall atmosphere. Then you have carbon intensity. So carbon intensity in the basic form is that sort of first tranche of financial normalization, whereby you take carbon emissions for a company, you divide it by their revenue, and then that gives you some sort of gauge on comparing companies to companies. So it gives you, okay, how is this company as a function of their revenue, how really carbon intensive are they? And then wrapping that up, what has been done in the past traditionally is this weighted average carbon intensity, generally using revenue, but the weighted average carbon intensity is for investors who have portfolios who then can actually use the weights of their portfolios to then wrap up that carbon intensity, to then try and get a gauge of where their portfolio is at in comparison to others in the market. And so from that we sort of have built upon that and have used and have built a carbon efficiency rating, which I'll sort of get to now. If you look at the carbon metrics for finance, again, I've sort of tranched this bit. So to try and get an exposure, carbon exposure, you've got the traditional metric, so revenue, which is sort of wacky, this weighted average carbon intensity. The problem with wacky, and revenue is that it's single focused. If a company it's just based on revenue, obviously it's not telling you much about the financial health, the other areas of finance that are relevant to the company, whether it's earnings, assets, dividends, how their debt is, their liquidity, and so on. So in the past, this has been fine, but it's really insufficient to really get a good handle of the financial risk associated with a company. The EU in 2019 actually recognized that, and they've actually advised against using revenue and went to enterprise value, which is better than revenue. Has a more holistic, a greater holistic sort of perspective on the value of a company versus just revenue. But still, the EVIC does miss a number of other areas. It's along the way, but it's better. So what we did at ME, this is Michael Levin's financial perspective here, not mine, is that we've expanded those. So we have a carbon exposure for revenue and EVIC, but as well as that, we can actually benchmark others, so earnings, assets, all these other areas. So why do we do that? Well, because each of these different functions, each of the different areas in finance give you different understanding of what a company is, depending on the company. So carbon, and we call this carbon value, it's the resilience of the long-term value to the carbon emissions. Whereas in leverage, it's the sensitivity of debt repayment ability to carbon. So if a company is high in debt, then a carbon constraint coming in is really going to cause them big issues, for example. But you'll miss that if you just focus on enterprise value or revenue. Liquidity, the same thing. Companies has the ability for their short-term assets to absorb prices. And finally, we do take into a trend because trends are important. So it's the evolving ability to understand how a company's tracking is important as well, to understanding how they will be impacted by future carbon constraints. So ME gives this a more comprehensive picture of financial health, carbon health for a company. And with this, the ME Global Carbon Efficiency Rating that we've come up with, you can also forward look. So here's a really good sort of perspective on how we do this. So what I've plotted here again is the carbon. This is the global emissions, so in billions of tons of CO2 from industry. We're at about 36 billion. But going forward, you've got three different carbon trajectories. You've got the 1.5 degree world, net zero world by 2050. You've got the 2 degree world via the Paris aligned 2 degree world, and then you've got the business as usual, which is a 3 to 4 degree trajectory. So what we can do by having the GCR framework in place, and this, I guess you call it the algorithm that benchmarks each company based on their financial carbon risk, is that we can then propagate this forward in terms of how each company is going to be set up for these different worlds. So if you have a rating of 100, you are aligned with a 1.5 degree world. You have very low carbon risk. Whereas if you've got if you're aligned towards a 2 degree world, there's medium carbon risk, and then obviously if you're aligned with a 4 degree world, there's sort of high carbon risk. So that the rating goes from 0, which is the high carbon risk 4 degree business as usual, down or up to the 100, which is the best rating for your sort of net zero alignment. That gives you a perspective on how the different scenarios we use within this GCR, the carbon efficiency rating. This probably shows you a little bit of detail around how we do this. Again, it sort of wraps up from a company level. We have scope 1, scope 2, and scope 3 emissions with their finances. We do some fanciness around how we predict and expand the scope of that data to make it more timely. And then from that emissions, we then benchmark each one of these there's 12 different metrics financially. We carbon adjust each one of them. Could be based on budgets. It's sometimes based on carbon price. So we have a carbon price propagating forward as well in the algorithm moving into the future. And then that gets classified into different areas of financial health, from the value, the leverage, or liquidity. And so from that, it can be aggregated. It's aggregated up to this, again, this rating, this efficiency, carbon efficiency rating, is how efficient is this company based on their carbon emissions and their financial health. Do they have the ability and the resilience to transition into a carbon constrained world? It's essentially what this GCR does. So the question you probably ask, why we do this, aside from the really core bit, it gives you a more complete perspective on the financial health of a company. And as a really good example, here's FedEx. So I think I've pulled this out. So FedEx is a big transport company, courier company, has lots of planes and trains. Now, huge revenues, and it's also got quite a big emissions. I think it's about 40 million emissions each year, but hundreds of billions in revenue. If we just took, and from our perspective as they have a medium carbon risk, but what I want to sort of focus in on here are the metrics that we come in on. So in the ME system, we have these different metrics that we can benchmark. So 0 being low carbon risk, 100 being low carbon risk, high carbon risk, low carbon risk. So if we just focus in on revenue, so if you just looked at just essentially carbon intensity, think of it that way, the revenue divided by their carbon, they've got a really good score. So it's 100. So just look at the orange here. The universe is black here, but the orange is FedEx. They are aligned with a 1.5 degree world based just on their revenue. But of course, there's all these other areas, their assets, their debt, their dividends are really exposed to carbon. So in other words, the company is operating on very tight margins. So when a carbon constraint comes in, their revenue may not be exposed, but these other areas are. So they may not be able to pay their debts, or their dividends are exposed. So you can see here the dividends, these other areas. So really, why are we introducing this new metric? Well, because we think it gives a much better, complete, holistic view for the market to understand really the financial risk of a company and their health. The other thing it does is that by building this framework of the better, I guess, better data in terms of understanding the uncertainties in our data, also the framework to which is a more complete, complete perspective on the company's financial carbon risk, we can propagate those uncertainties through. So this is really important here, is that there is no one solution going forward here. Obviously, there's uncertainties in the data. For example, in scope 3, there's a lot of uncertainty in the data, even if we estimate the scope 3 emissions for a company. But what we can do with our infrastructure and framework is that we do standard Monte Carlo analysis, where we can actually propagate those through and look at risk bounds. So what I'm showing you here is an example of 5 real companies that I've anonymized based on, and this is their risk, this is their overall carbon risk. And here I've just shown you the dots. So we do Monte Carlo analysis based on the uncertainties within the system. So you've got low risk to high risk. Some of these companies, the uncertainties in the carbon data, for example, this company doesn't mean much. You know, company F, they've got sorry, it's actually the wrong way around here. I've said high risk, but it's low risk. 100 is good. So sorry, invert that. So company F here is really high risk, 0 in terms of their rating, but the uncertainties don't do much. They're still bad. Like, so even if there was a really high uncertainty on the data side, we know that they're bad. They're still in terms of their risk profile. Whereas others, company A and company B, you can see that actually the carbon, the data uncertainty propagates through, and there is quite a range of outcomes here. But the box here is the likelihoods. So we can hone in on this particular area. And from our perspective, we're talking about an order of magnitude issue here. So you're wanting to see if one of these areas, one of these boxes really do shift or expand beyond the realm of the low, medium, and high risk. That's where there might be problems. But in most cases, these bounds don't really cover big changes within the carbon efficiency rating. So really, it helps us understand, by having this framework, help us understand and propagate through the uncertainties in what we have in terms of the data to understand the company. Beyond that, we can then go into the future. So you can just see what can happen here, scenarios based on the future. So there's net zero. There's not one net zero pathway within the market. There's an infinite possibility of scenarios under the net zero lens of a global constraint. So you can then propagate these through in the future as well in terms of scenario analysis. So it's really exciting to have this framework up from our side at ME to really power those future scenarios. Once we have the carbon efficiency rating for a company, we then can wrap that up. So you can just wrap that up in terms of a weighted average for a portfolio level. So, and that's what we have in the system now. We have a software interface that allows that to happen. So what I'm wanted to come back to the key points here. So in terms of understanding carbon risk, I hope I've given you some perspective on where we're at. The key challenges were around data and also metrics. Now, by actually providing a way for us to move forward, at least to get better coverage on data and have a more complete metric that allows complete financial health, along with the technology infrastructure, the first bit I've covered, so this today really we've talked about mostly this quantifying this carbon transition risk for both companies and then wrapping that up to portfolio levels for investors. But the exciting bit is the future. And this is where, by what we've done, it allows investors to build their own view of the world and their own models under that net zero lens, or under the lens that they think the future will take place, how that'll take place. And then beyond that, it really allows scenarios and stress testing, which is the next tranche of big regulation coming forward from the central banks as well, in terms of understanding how a company and portfolios are really capable to withhold the carbon constraint coming forward. And that by doing these first bits, this infrastructure that we've built up, that really helps that ecosystem. And finally, I think the most important thing is I hope we can move away from screening as a tool, because I think it really, to enable markets to really accelerate towards net zero, we need to ensure they can do it profitably. They can do it with efficiency. And screening is not the way. As I said, carbon is not a binary problem. It's a transition, and there's infinite possibilities. So we have to build the infrastructure to allow that to occur and for information to flow. And so I will leave it there. And I hope that was helpful to some people, and I'll be happy to take some questions.
Wonderful, Ben. Thank you very much. So you've created quite a bit of discussion on the chat forum already. So yep. One of that discussion was around that point that moving away from screening, and yep. A couple of the participants have been chatting around that. Yep. And there's a bit of a debate there going on. But I thought your example of FedEx is really good, right? Because you've got a firm that looks like it has a low carbon intensity purely because it's a low margin business, right?
Yeah.
And so it's actually very misleading, right? But I just wondered if you wanted to comment any more, because as you can see,
on the screening perspective, yeah. So I guess screening has its place from an optical perspective and an ethical perspective, I think, Ivan. I don't think it has a place for a lot of participants in the market to really to understand that there is a transition. So, for example, I know that if we shifted if we just divested everything into technology, what would happen? Ivan, you tell me from the finance perspective. It would obviously there are companies within each sector, for example, the exposed one, or let's say it's oil and gas, where they will be transitioning really well. Some of them won't, because they don't believe it's necessary. It's those companies that are going to have the biggest change. They're going to make the biggest change on carbon in the atmosphere. Those companies that transition. And so by avoiding them and not actively engaging them, we are you're missing potential to really from the market perspective to see upside. But most importantly, from my perspective, I want to see action from the atmosphere. So they will have a huge impact on the atmosphere. Right now, if you just invested in Google, it's not doing much. Right? It's not changing anything. But if you invested and actively engaged, for example, a company who's really on the net zero pathway, and here's their plans, and here's the capex towards R&D, towards their flipping the switch in the future, then that's where we need to be, because that's where the wedge that big chunk of carbon that I mentioned at the start. That's where it will really come down from those companies doing the transition.
Cool, wonderful. So a couple of technical questions. So how does aggregate emissions metrics measure the alignment to various scenarios? So how is a link created? And then a similar sort of question, how can you elaborate on how you account for the effects of carbon budget for each sector company?
Yeah, so the first one is how we do it is we benchmark. So we have think of it from a benchmarking perspective, a budget perspective. You've got this carbon in the atmosphere that's changing. We know what those budgets are. If GDP doesn't change, for example, in the future, you've got a carbon divided by GDP, let's call that revenue, but for now, as an example, theoretically, then you can understand what benchmarks, let's say, that particular revenue is. You can also do that for different financial. You can order do it for the different financial fundamentals within a company. Again, that's could be carbon pricing. So there's a carbon price in there that relates to some areas within the fundamentals other than the budgets. But really, it's a combination of those. Happy to send through. We have quite a long methodology document, and Michael's not on the call, who would actually know more about that. But we can send through a very detailed methodology document on how we do it. In terms of what was the follow-up, Ivan, that was in terms of forward-looking, is that right? How do we do the forward-looking scenarios? Is that what you were saying? I can't remember what was. You there?
Sorry. Oh, yeah. Sorry. I turned my mic off. So can you elaborate on how you account for the effects of carbon budgets for each sector company?
So for sectors, we don't. So what we wanted to create was a benchmark for any company. So there is no assumption on the airline sector has this budget, or the oil sector has this budget. What we did was from the carbon in the atmosphere doesn't matter in terms of that. From that perspective, it doesn't really matter. It's the carbon budget that's in the atmosphere. So we essentially normalize it to any company. Why we did that is to provide a framework to allow others to have their own play on what they think budgets will be aligned. So yes, in political terms, there's probably going to be areas where there's going to be inelasticity of those carbon budgets and others elastic. So if there's no technology switching, for example, in airlines, maybe you could have an argument there that that's the case. We don't want to actually give people those answers. We want to create the framework to allow others to come in to then have their own, to give their own overlay. You know, what are their own, what do they think? And this is, again, to institutions as well as academic institutions. What are they? How do they see the world in terms of those sectors? Because there isn't one answer there. It's obviously uncertain. So we wanted to get the really data-driven. There's no opinions here in terms of what we have. It's a carbon benchmark for any company, whether it's the news agency down the street or it's BHP. That allows then the infrastructure for people to then work off their different sector analysis, their different assumptions, and then propagate that forward.
Wonderful. There's quite a few questions, but since it's a mixed audience and the students need to head on, and I need, there are various other things going on. So
sure.
I just wanted to thank you. There's plenty of other questions, plenty of interest, but if anybody really wants to reach out to you, then they can potentially come through me. Again, thank you very much, Ben. It's really been interesting, and by the amount of discussion that you've generated in the chat, it's definitely a hot topic, and I think there's plenty of issues to be resolved.
Yeah, sure. I'd love to. Maybe we can have an AMA later, Ivan. We can just ask me anything, you know, and just an informal one. I'm happy to do that too. For sure. And you had a great audience, really mixed bunch of people. So yeah, thank you very much. And thank you very much for everybody who attended. And our next webinar is Paul Carman, and he is a professional that's been looking at the debt market, trying to develop the private debt market here in New Zealand, called Private Capital Group, and he's going to talk about that development and how ESG can be integrated into that. So we hope to have as many of you there as possible, and those of you that aren't registered with CEF Group, do look at our website and send us an email, and we can add you to our distribution list. But for now, all that remains to be said is thank you, Ben, and thank you everybody for joining us, and enjoy the rest of your day. Thanks, Ivan. All the best. Bye now.